Howdy, Jacob here. Today we're looking at Costar Group in the professional services industry, 30 billion market cap, 26 billion enterprise value. They provide information, analytics, and online marketplace services to commercial real estate, hospitality, residential, and related professional industries globally. Founded in 1987 out of District of Columbia, return of revenue growth has been absolutely astounding. They have the lowest year-over-year revenue growth that they've had recently, but even still 12% revenue growth with an 80% gross margin. Operating margin down recently, but has been as high as 26%. No dividend paid. Return on invested capital is a little bit shorter than what I would like, but not terribly surprising. R&D at $300 million. That's over 10% of their revenue. So they're really taking money away from today to hopefully get some more growth in the future. Not bad. Their balance sheet shows $5.1 billion cash, zero short-term debt, less than $1 billion long-term debt. I'm definitely not concerned with that balance sheet. I wonder what they're doing with this cash. I want them to start utilizing it, make some investments, buy back some shares if they're cheap. I mean, don't just be sitting on $4 billion cash, but maybe they're looking for opportunities to make some acquisitions. This jump from $1 billion to $5.2 billion, again, that just means it's a safer balance sheet, but it really make me think, what do I want to do with this money? Because sitting on it is really not going to give me a great investment. Even if they give it, their return on invested capital is as poor as 5%, invest in something. So, I mean, use of cash recently has just been acquisitions. They issued a bunch of shares over here, issued a bunch over here, bunch right there. I have no idea why they're doing that. Issued debt right here. I just can't understand this at all. What am I seeing here? They issued $1 billion in debt. They issued $1.6 billion in common stock to buy back $426 million, which they had produced in free cash flow for an acquisition. This capital allocation is just wonky as whack to me. I'm not doing anything. Like, I've seen people issue debt to buy back shares or make acquisitions or reinvest in yourself, but we're just not seeing that here. They have the free cash flow allocation to do everything that they want to do and more, but they're just increasing their cash balance, and they're issuing shares and issuing debt to do this. I don't comprehend this business. Again, I'm just looking at the numbers here. So if I were to do a deeper dive, hopefully I'd find out what's going on. But that's kind of annoying me. I don't know why they would be doing something like that. So I'm just going to make some assumptions here and we'll see where it's at. So revenue growth, massive revenue growth, probably 8%. Return on invested capital is pretty poor, but they'll probably still have greater than average growth rates, probably 20, 22, pretty high margins. Share change, 89 million is stock-based compensation. That's not doing anything. But they have been issuing shares. I'm going to say they don't do that because I don't know why they would do it. To me, it just looks extremely overpriced at the current price point. Maybe you think it's going to grow 20% a year with a 30p. Still looks extremely overpriced. And that seems like the most ridiculous assumptions ever. So to me, one, I don't understand the numbers, and two, it looks like a pretty high price for me. So I won't be doing any deeper dives anytime soon. I'm going to be looking at other companies that I understand that are more attractively priced to me. Hope you enjoy the video and have a great day. Thank you.